Hello students, so now we are on to the lecture number 14 of Amalgamation. Question number 13 is what we are going to take up, and I don't think I have to give you the instruction again that you try the workings on your own, pause the video and then play and verify you got it correct or not. Now you do it the way you all want it, okay? You all are mature enough to understand how to try the questions on your own. So look at the things. A Limited has agreed to acquire, and this agreed to acquire goodwill and assets, except investments. So investments are not taken over, except investments. Investments are not taken over by A Limited. A Limited has agreed to acquire goodwill and assets except investments of B Limited. Now A Limited has agreed to acquire means A Limited is transferee company of B Limited, so B Limited is transferor company. As at 31/12/18. Also, if you see in all past questions, the language has been A Limited acquires the business of B Limited, and that business includes assets as well as liabilities. But here it is mentioned acquire goodwill and assets. Liabilities part is not mentioned. We'll see in the adjustments what information is given about liabilities. The balance sheet of B Limited as on that date was as follows. Share capital rupees 10, 1,60,000. So 1,60,000 divided by 10, 16,000 shares would be there. We always find this information because it helps us in the workings to calculate the purchase consideration, etc. General reserve, P&L, debentures, creditors, provision for tax, foreign project reserve. Actually, debentures, creditors and provision for tax, these three are outside liabilities, external liabilities. General reserve, profit and loss account, and even foreign project reserve is reserves and surplus. Goodwill, land and building, plant, investments, stock, debtors, bank and bills receivable. Now, A Limited will discharge the debentures at 8% premium. Means 8% premium means agreed value is 8% more than the book value. Okay, where discharge word comes, what we get is agreed value. We have done it many number of times. And 8% premium, so 60,000 are debentures plus 8% premium, 4,800. So 64,800 is its agreed value. By issue of 15% debentures in the old company, they have 12% debentures. In the new company, they will get 15% debentures in A Limited, but issue at 10% discount. Okay, issue at 10% discount means in the new company, how many debentures we will be issuing, we will find by dividing by 90 rupees. 10% discount means we'll be dividing it by 90 rupees to get the number of debentures to be issued in the new company. Issue of 3 shares of A Limited at market price of rupees 11. So 1 rupee is premium. Okay, market price of rupees 11 means 1 rupee is premium for 2 shares of B Limited. We always take second part first when we make the workings. We'll see that in detail when we make purchase considerations workings. For every 2 shares, 3 shares are issued of A Limited. So for 16,000 shares, how many? That way. Pay rupees 2 in cash for each share of B Limited. So these two will help us in getting purchase consideration. Pay absorption expenses. Who will pay? This all is going to be done by whom? A Limited. A Limited will discharge, A Limited will issue, A Limited will pay, A Limited will pay. Rupees, absorption expenses rupees 3,000. So this entry of expenses of liquidation will come in the books of transferee company. Now B Limited sells investments for 32,000. It was given in the question that except investments all assets are taken. So investments are sold by transferor company B itself for what amount? 32,000. So separate entry will come in the books of transferor company, sale of assets, cash and bank to realization. Even one-third shares received from A Limited were sold at rupees 10.5 each. This also we have done it almost, I think, 3 times earlier in past questions. So we'll see the workings when we do this in detail. Now, new point is tax liability is determined at 24,000 and provision for tax is 20,000. So you can say that tax liability is determined at 24,000 means who is going to pay the provision for the, it is mentioned that A Limited acquired goodwill and assets, means tax is not acquired by A Limited. So tax is going to be paid by transferor company itself. Okay, tax is going to be paid by transferor company itself, means by B Limited itself. How much? Against 20,000 the liability is 24,000. So provision for tax is a liability which is not taken over by A Limited. It will be paid by the transferor company B Limited itself. We will have that entry payment of liabilities in the books of transferor company. And today that point will also get covered where different amount is paid for liability. So difference gets transferred to realization account. 20,000 is the liability in the books. 24,000 is now we have to pay. So 4,000 of difference will be transferred to realization account in the entry of payment of liability in the books of transferor company. Okay. Before transfer, now this is also important. Before transfer of B Limited declares and pays dividend of 10%. Before transfer, B Limited declares and pays dividend of 10%. This is important everyone, new adjustment. We haven't come across this adjustment in past. Now what does this adjustment indicate? Be attentive everyone. Okay, first we discuss this adjustment in detail. Let us say I make a working note 1 for this adjustment exclusively. So first of all, what would be the 10% amount of dividend? B Limited, and it's again before transfer, means before A company acquires the B company, B Limited itself is declaring and paying a dividend of 10%. We always count dividend on share capital. So 10% dividend will be calculated on share capital of 1,60,000. Dividend by B Limited. There's a new adjustment. First time we are coming across that. 1,60,000 is share capital into 10% dividend would be 16,000. Now before A company takes over B Limited, that is before the transfer, B Limited has declared and paid this dividend. For declaring the dividend, the entry is, you always declare the dividend from the profits of the company. So profit and loss account debit to dividend payable account. If at all journal entries were asked, then you would pass this journal entry also in your solution. 16,000. I repeat, this is the entry for declaring the dividend. To declare the dividend, what is the entry? You take the dividend from the profits of the company. So profit and loss account debit, and dividend payable is our liability. Credit the payable, so to dividend payable account. Now after declaring, it has also paid it. So for payment, what will be the entry? Okay, all of you can see that B Limited before the transfer declares also and then pays also. So payment is also done. So for payment, what will be the entry now? Dividend payable, you will reverse and debit. So dividend payable account debit with 16,000, and then cash goes out, credit what goes out to cash and bank account 16,000. All of you can leave around this ledger accounts space of 2 pages, 2 or 2.5 page, whatever page you consume for ledger accounts. 2 pages are sufficient, I think. And then you can make this workings for dividend. There's a new entry. Dividend will be calculated on share capital. Share capital is 1,60,000. So 10% dividend 16,000. For declaring the dividend, the entries you take from the profit. So profit and loss account debit to dividend payable account. For payment of dividend, the entries dividend payable account debit to cash and bank account. Now if you combine these two entries, then what happens? Dividend payable credit and debit 16,000 gets closed. So what is the combined entry? Profit and loss account debit to cash and bank account. Now profit and loss account debit means it will get subtracted from P&L account. Okay, here profit and loss account, it's a credit balance. Liabilities side means it's a credit balance of 18,000. From that we declare and pay a dividend of 16,000. So now what amount of P&L account will remain? 2,000. What is the importance? When in the books of transferor company we pass the entry of transferring reserves and surplus to equity shareholders account, in that profit and loss account only 2,000 will be transferred to equity shareholders account, because from 18,000 we have given dividend of 16,000. So now in the ledger of P&L account, after that entry, what balance is remaining at the time of amalgamation is only 2,000 rupees. Okay, I repeat, when we transfer reserves and surplus to equity shareholders account, only 2,000 of P&L accounts balance will be transferred to equity shareholders account, because from 18,000 we have declared and paid a dividend of 16,000. So only 2,000 of balance remains in P&L account. This is the effect of profit and loss account debit. Dividend gets cancelled. To cash and bank. Cash and bank is a debit balance, but we credit it. So again debit credit minus. In P&L also credit debit minus. In cash and bank also debit credit minus. This is a debit balance, but we credit it. So from 20,000 we have used 16,000 in paying the dividend. So now what balance is remaining? Only 4,000. Means again, in the first entry, when you transfer assets to realization account, what amount of cash and bank will you transfer to realization account? Only 4,000. Because 16,000 is already used in paying the dividend. So at the time of amalgamation, the cash and bank balance available in the books is only 4,000. So liabilities side also decreased by 16,000, asset side also decreased by 16,000 after this entry. Okay, I repeat it once again. P&L account 2,000 will be transferred to equity shareholders account, and cash and bank 4,000 will be transferred to realization account. I hope everyone is clear with this portion. Any confusions in that? Okay, further. A Limited values land and building at 1 lakh. So agreed value of land and building is given to you. Plant at 10% less than book value. Plant is 80,000, so 10% less would be 80,000 minus 10%, that is 8,000 less. So 72,000 would be the agreed value of plant. Stock 35,000. Debtors subject to 5% provision. So debtors are also 50,000 subject to 5% provision, means 50,000 minus 5%. The debtors would be 47,500. Okay, debtors agreed value will become 47,500. Prepare necessary ledger accounts in the books of B Limited and pass journal entries in the books of A Limited. B Limited means transferor company necessary accounts, and A Limited means transferee company, only journal entries are asked. Now you all very well know, first we have to decide, is it amalgamation in the nature of merger or purchase? Second, method of purchase consideration. And third, if it is merger, pooling of interest method. If it is purchase, purchase method of accounting. Okay, so first let's decide whether is it merger or purchase. First condition of merger, all the assets and liabilities must be taken over. Investments are not taken over. Even provision for tax is not taken over. The question remains silent about creditors. The question remains silent about creditors, means creditors are taken over. Okay, question remains silent about creditors means creditors are taken over. If nothing is mentioned, then we cannot assume that company itself is paying to the creditors. So A Limited has agreed to acquire assets and goodwill of B Limited except investments, means in assets they are saying investment is not taken over, and in liabilities provision for tax liability is given, so liability is not taken over. Nothing is given about creditors, means we assume creditors are taken over. However, it is purchase because investments and tax liability is not taken over. All assets should be taken over. Even second condition is not satisfied. At book value, land and building, plant and debtors agreed value is given, even debentures agreed value is given. Even third condition is not satisfied. Entire purchase consideration should be paid in shares, and adjustment 3 we are paying cash also. None of the three conditions are satisfied, so it is amalgamation in the nature of purchase. Purchase consideration method, net payment method, which we conclude from adjustment 2 and 3. Because the modes of payment are shares and cash, and all the details are given, nothing is missing. And because it is purchase, we will follow purchase method of accounting in the books of transferee company. Okay, so these three basic points we have decided. Now we make the workings. Needless to say that all of you try the workings of debentures on your own and the workings of net payment method on your own. You pause the video and try that, and then you play the video and verify you got it correct or not. Come on, all of you try on your own first. Okay, now I assume all of you should have tried with it after pausing the video. So understand the second working of debentures. Presently we have 12% debentures of 60,000. Okay, presently we have 12% debentures of 60,000. So 12% debentures of B Limited are 60,000. Now they are going to be discharged at 8% premium. Okay, they are going to be discharged at 8% premium. See here, discharge the debentures at 8% premium. So we discussed agreed value is 8% more. So in that we will add plus 8% premium, means more value we are going to pay. So 60,000 is 8%, 4,800. We will be paying 64,800. That is the agreed value. Okay, agreed value of debentures is 64,800. Now, how is it going to be discharged? By issue of 15% debentures at 10% discount. So, what are the number of 15% debentures of A Limited to be issued at 10% discount? $64,800, 10% discount means 90 rupees will be the issue price. Okay, 64,800, 10% discount means 90 rupees will be the issue price. So 720 debentures. Okay, in the new company, 720, 15% debentures would be given. So I hope everyone has got this workings correct. Third working will be for purchase consideration by net payment method. Again, needless to say, pause the video and try it on your own. Then play the video and verify you got it correct or not. Okay, purchase consideration by net payment method. First we write modes of payment. Now there are two modes of payment here. First, equity shares. Okay, first mode of payment is equity shares. That we are given the information in adjustment 2. See here, issue of 3 shares of A Limited for 2 shares of B Limited. We always take second part first. For 2 shares of B Limited, so you'll write for 2 shares of B Limited. Now in the beginning it's given 3 shares of A Limited will be issued. Okay, issue of 3 shares of A Limited. First part you take second part you take first in the workings. So second part, for 2 shares of B Limited we take it first, then issue of 3 shares of A Limited we take it next. Now in the beginning, how many shares are there in the books of transferor company B Limited? 16,000. So for 16,000 shares of B Limited, how many shares will be issued in A Limited? 16,000 into 3 divided by 2, 24,000. Now 24,000 shares will be issued in market price 11, 1 rupee premium it is going to be issued, it is given at rupees 11. Shares are of 10 rupees but they are going to be issued at rupees 11. So what will be the value? 24,000 equity shares of rupees 10 each, but at the rate of rupees 11. So 24,000 into 11, 2,64,000 is the value paid in terms of equity shares. Now second mode of payment is cash. Adjustment 3, what is given regarding that? Pay rupees 2 in cash for each share of B Limited. Pay rupees 2 in cash for each share of B Limited. There are 16,000 shares in B Limited. So how much will we be paying in cash for 16,000 shares? 16,000 shares of B Limited multiplied by 2 rupees in cash. So 32,000 we will pay in cash. Mind well, don't multiply with this 24,000 equity shares. 24,000 shares they are going to get in A Limited company. Presently in B Limited there are 16,000 shares, and for B Limited's existing shares they'll get 2 rupees in cash. So 2,96,000 is purchase consideration. 2,64,000 plus 32,000. 2,96,000 is purchase consideration. I hope all of you would have got it correct when tried on your own. Okay. So now all of you can pause the video and make the formats. Which formats? Realization account around half a page. Then equity shareholders account 8 to 10 lines. A Limited transferee company, A Limited's account 4 lines. Equity shares of A Limited account 4 lines. Also make provision for tax account. Because tax liability is not taken over by the new company, also make provision for tax account. Okay, and then cash or bank account, because cash is received also, assets are, shares are also sold, investment is also sold, so cash and bank account also we have to make. So all of you make these formats. Provision for tax account 4 lines, cash and bank account around 6 to 8 lines. Okay, pause the video and make these formats. Yes, I hope everyone has done the formats. So we will proceed with the entries. Okay. Now first entry in the books of transferor company is realization account debit to assets account. Realization account debit. So in realization account we'll write on debit side opposite account to assets account. Now in that we will take all the assets from the balance sheet at book values. Okay, all the assets from the balance sheet at book value. So goodwill is 20,000. Then after goodwill, land and building is 80,000. Then after land and building, plant is 80,000. Then after plant, investments are 30,000. Then after investments, stock is 40,000. Then after stock, debtors is 50,000. Then after debtors, bank balance, but as we discussed, bank balance what will be transferred to realization is only 4,000, because from 20,000 we have paid dividend of 16,000. So now the bank balance remaining in the company is only 4,000. That will be closed and transferred to realization account. Then after bank 4,000, bills receivable 8,000. Total 20, 1, 180, 210, 250, 3 lakh, 3 lakh 12,000. Total 3 lakh 12,000. Okay. Now opposite effects where we have to give only bank account because we are making bank account. So first of all of you note down this. Bank balance is actually 20,000 in the books. So all of you write down in cash and bank account debit side to balance brought down 20,000. Now from this 20,000, first we paid dividend of 16,000. So we can see this working note 1 we had done. To cash and bank account means cash and bank credit side. We will write the opposite account by dividend payable account 16,000. So from 20,000 we have paid dividend of 16,000. Okay. And then by realization account, what we have transferred to realization account is remaining 4,000. So I hope everyone is clear with this making of cash and bank ledger account. Okay. 20,000 is the balance given in the balance sheet, balance brought down. From that 16,000 we have paid for dividend. So cash and bank credit side by dividend payable account 16,000, and then in realization account we have transferred remaining of 4,000. Okay. Next, second entry will be liabilities account debit to realization account. Now all of you keep this in mind. In assets we transfer all assets to realization account whether taken over or not. So even investments is transferred to realization account though it is not taken over. But in liabilities, we transfer only those liabilities to realization account which are taken over. Here debentures is taken over, and since the question remains silent about creditors, we assume creditors are also taken over. So debentures and creditors will be transferred to realization account. To realization account means in realization account on credit side by liabilities account. Okay, in realization account credit side by liabilities account, in that old company has 12% debentures of 60,000, 12% debentures 60,000, and creditors are 37,000. All of you can see that creditors are 37,000. So by liabilities will include creditors 37,000, total 97,000. Okay, second entry is then liabilities to realization. Now here, which liability is not taken over and not transferred to realization account? Provision for tax 20,000, because that tax liability determined 24,000 will be paid by transferor company itself. So in provision for tax account, all of you write down the opening balance by balance brought down 20,000. This is not transferred to realization account. It is not yet closed. It will be closed only after its payment. Okay. So second entry is done. Liabilities are closed and transferred to realization, but only those liabilities which are taken over are to be transferred. So provision for tax is not transferred and its balance remains as it is in the ledger account. Third, equity share capital to equity shareholders. So share capital is 1,60,000. To equity shareholders means equity shareholders on credit side by equity share capital account 1,60,000. Then preference share capital to preference shareholders, we don't have preference shares. Then reserves account debit to equity shareholders. Reserves, we have general reserve, profit and loss account, and foreign project reserve. So general reserve 25,000 to equity shareholders means equity shareholders on credit side by general reserve 25,000. Then we have profit and loss account of 18,000 minus 16,000, 2,000. Keep it in mind. We discussed that P&L account we have given a dividend of 16,000, so only 2,000 will remain. So to equity shareholders by profit and loss account, but in bracket from 18,000 we subtract 16,000 given as dividend, so only 2,000 will be transferred to equity shareholders account. Then foreign project reserve 8,000, so by foreign project reserve 8,000. Okay, so this entry is also done. Fifth entry, reserves account debit to equity shareholders account. Then after that we have fictitious assets or other non-current assets or other current assets item that we don't have. We don't have any item on the other side which is in the nature of other non-current asset or other current assets. So first 6 closing entries are done. Now 7 and 8 purchase consideration. So in working note 2 we have calculated purchase consideration 2,96,000. Transferee company, that is A Limited account debit to realization account. To realization account, so realization account on credit side by A Limited account in bracket purchase consideration in bracket further working note 2, I think working note 3. Okay, working note 1 was of dividend, 2 was of this debentures, and 3 is of purchase consideration. So working note 3, 2,96,000. Now A Limited account debit, so in A Limited account on debit side to realization account, $2,96,000. Okay. Then after that purchase consideration received. Now what is the purchase consideration received? All of you can see in working note 3. Equity shares comes in, debit what comes in? Equity shares of A Limited account debit with 2,64,000, and cash comes in, debit what comes in? Cash and bank account debit 32,000. A Limited is the giver, credit the giver to A Limited account 2,96,000. To A Limited, so A Limited on credit side by equity shares of A Limited account with 2,64,000. and by cash and bank account with 32,000. Opposite side in both the accounts, equity shares of A Limited account debit side to A Limited account 2,64,000 and cash and bank account debit side to A Limited account 32,000. So purchase consideration received is done. Two entries of purchase consideration are done. Now next is sale of assets. Investments are sold which are not taken over. This we have it here. B Limited sells investments for rupees 32,000. Now what is the entry for sale of assets? Cash and bank account debit to realization account. Since assets are already closed and transferred to realization account. To realization account, so realization account on credit side by cash and bank account. In bracket you can mention investments. This entry is for selling of investments. And amount is they are sold for 32,000. Okay, cash and bank account debit to realization account 32,000. Cash and bank account debit, so cash and bank account debit side to realization account in bracket investments 32,000. And we discussed we don't record its profit or loss. You can see in balance sheet investments are 30,000 but sold for 32,000 means there is a profit of 2,000, but that we don't have to record because that automatically gets recorded. How come it automatically gets recorded? Investments are closed and transferred to realization account with 30,000 we have debited, sold for 32,000 we have credited. So what is the net effect of these two entries? 32,000 credit, 30,000 debit, 2,000 credit, net amount remains. That represents automatically our profit. So no entry is to be made for profit or loss of this entry of realization. That automatically gets recorded. I hope everyone is clear with this portion. Okay, we don't have to make any exclusive entry for profit or loss on sale of asset. It automatically gets recorded. After sale of assets, we have payment of liquidation expenses. Here we don't have that because absorption expenses 3,000 are going to be paid by transferee company. A Limited is going to pay that. So no entry of liquidation expenses. Then payment of liability. Now tax liability is determined at 24,000. So we have to pay 24,000 of tax liability. And then here we discussed in the entry, if you remember, difference will be transferred to realization account. Okay, difference will be transferred to realization account for payment of liabilities. If you all see, liabilities to cash and bank and any difference amount is to be transferred to realization. Because unlike assets, here only those liabilities were closed and transferred to realization account which are taken. First let us do the payment. 24,000 is paid. So provision for tax account debit to cash and bank account 24,000. Okay, provision for tax account debit to cash and bank account we are paying 24,000. Opposite side in cash and bank account by provision for tax account or by tax liability account 24,000. Okay, tax liability account debit to realization. So provision for tax account debit, liability account debit to cash and bank, payment of liability. So provision for tax account debit to cash and bank. Provision for tax account debit means debit side opposite account to cash and bank 24,000 to cash and bank. So cash and bank credit side by provision for tax 24,000. Now this provision for tax difference of 4,000 will be transferred to realization account. We had created a liability of only 20,000 but now we have to pay 24,000. So 4,000 is our loss. That loss is to be debited to realization account. That will now be borne by equity shareholders. So by realization account, in bracket, balancing figure, and opposite side in realization account, to provision for tax account 4,000. Okay, so after the payment of liability, whatever balance remains in liability account, we have to transfer to realization account. Here 20,000 of liability was already there in the books, but we have to pay 24,000. So 4,000 of loss, now difference amount will be transferred to realization account. If at all journal entries were asked, the journal entry would have been realization account debit to provision for tax 4,000. This extra entry would have come here. Okay. Then after payment of liability, payment to preference shareholders we don't have. Now there are steps. Realization will be closed and transferred to equity shareholders account. All other accounts will be closed and transferred to equity shareholders account, and equity shareholders must tally. First, realization will be closed and transferred to equity shareholders account. So credit side is more, all of you do 97,000 plus 2,96,000 plus 32,000. That comes to 4,25,000. So all of you write 4,25,000 on both the sides. Okay, realization account, all of you write 4,25,000 on both the sides. Now 4,25,000 minus debit side amounts will minus. So 3,12,000 and 4,000 we will minus. So what will remain is 1,09,000. Okay, just 1 minute everyone. One more entry is to be passed. That is, we forgot the entry for 1/3 shares received from A Limited are sold at rupees 10.5 each. Let us do the journal entry for this, then we give the effects. Entry working note for this. Working note 4. 1/3 of shares are sold. So 1/3 of shares which are sold will be equal to how much? We received 24,000 shares. So 24,000 into 1 by 3. 8,000 shares are sold. Now, 8,000 shares are sold, but they were received at 11 rupees and they are sold at 10.5 rupees. All of you can see here, they are sold at 10.5. So 50 paise of loss is there. Okay. So loss means we can pass a combined entry. Cash comes in, debit what comes in, cash and bank account debit. Now 1/3 means 8,000 shares are sold and they are sold at 10.5. So 8,000 into 10.5, 84,000. Then loss we will debit to realization account. So realization account debit all expenses and losses. 50 paise is our loss. So 8,000 into 50 paise, that is 4,000. And shares goes out, credit what goes out. So to equity shares of A Limited account, 11 rupees of shares go out. So 8,000 into 11, 88,000. I hope everyone is clear with this. We have done this earlier also. Now, two equity shares of A Limited. So equity shares of A Limited account on credit side by cash and bank account, 8,000 into 10.5. They are sold for 84,000. And realization account debit to equity shares. So equity shares credit side by realization account with the loss of 8,000 into 0.5, that is 4,000. Okay, and opposite side in both the accounts. Cash and bank account debit. So in cash and bank account debit side, to equity shares of A Limited account, 84,000. And realization account debit. So in realization account also debit side, to equity shares of a limited account with the loss of 4,000. Okay, this extra entry was there which we forgot in the beginning, and if you all have remembered and done, very good. Now we transfer the balance to equity shareholders account. So 1,05,000, 4,25,000 minus 3,12,000 minus 4,000 minus 4,000, 1,05,000 to equity shareholders account. In bracket profit. Opposite side in equity shareholders account by realization account in bracket profit 1,05,000. Okay, then whatever other accounts balances remain, there also we have to transfer to equity shareholders account. So A limited account gets closed, 2,96,000 on both the sides. Equity shares of A limited, whatever balance remains will transfer to equity shareholders. So 2,64,000 both the sides. Minus 88,000. So 2,64,000 minus 88,000. 1,76,000. Okay, 1,76,000 will be transferred to equity shareholders account. 1,76,000 by equity shareholders account in bracket balancing figure. Opposite side in equity shareholders account to equity shares of A limited account $1,76,000. Okay, I hope everyone is clear with this. Then after equity shares of A limited account, other accounts are to be closed. So provision for tax already gets closed. Cash and bank remains. That will also be closed and transferred to equity shareholders account. So in cash and bank account 20,000 plus 32,000 plus 32,000 plus 84,000, 1,68,000. And then 1,68,000 minus 16,000 minus 4,000 minus 24,000. So 1,24,000. Okay, 1,24,000 of cash and bank balance will also be transferred to equity shareholders account. By equity shareholders account in bracket balancing figure. Opposite side in equity shareholders account to cash and bank account $1,24,000. And finally, equity shareholders must tally so 1,76,000 plus 1,24,000, that is 3 lakhs. And credit side also we see that Credit side also you can verify 1,60,000 plus 25,000 plus 2,000 plus 8,000 plus 1,05,000, that comes to 3 lakhs. Okay. So all the entries are done in the books of transferor company. Now again all of you pause the video, make the format of journal entries in the books of transferee company, that is A Limited. And then I suggest you can try the entries on your own and later on you can verify you got it correct or not. Okay. Yes, so all of you would have made the format of journal entries of A Limited. Okay. Let's take over these entries now in the books of transferee company. First entry now in the books of transferee company is for purchase of business. So what will be the entry for purchase of business? Business purchase account debit. Business comes in, debit what comes in? Business purchase account debit. And the amount is payable to the liquidator of B Limited. Credit the payable. So to liquidator of B Limited account. With the amount of purchase consideration which we have obtained as how much? 2,96,000. Being business of B Limited purchased. Now second entry for taking over assets and liabilities, but again we are doing purchase method of accounting. So before we pass the second entry we will have to find goodwill or capital reserve. First we make the workings and we find net assets. In that first we take agreed value of assets taken over Now agreed value of assets taken over. Will we take goodwill? Yes or no? No, because goodwill is itself what we are finding. Straight away we'll take land and building, but not 80,000. Its agreed value is given here as 1 lakh. So land and building 1 lakh. Then after land and building, which is the next asset in the balance sheet? Plant. Plant. Is any agreed value of plant given? Yes, 10% less than the book value. Okay, all of you can see in this paragraph. So we discussed 80,000 minus 10% will take 72,000. So plant, all of you write down 72,000. In bracket here also you can show 80,000 minus 10% less value it is taken over at. So 72,000. Then after plant, which is the next asset? Investments. But investments are not taken over. Okay, all assets were taken over except investments. Investments are not taken over. Stock. Is any agreed value for stock given here? No. That means, okay, stock is given. Stock at 35,000. Okay, so stock's agreed value we will take 35,000. Then after stock, which is the next asset? Investments not taken on the stock. Stock, then debtors. Debtors it is given 10%, no 5% provision. So 50,000 minus 5%, we discussed agreed values 47,500. Okay, debtors 50,000 minus 5%, 47,500. Then after debtors, what do we have? Bank balance. But bank balance, what amount? 4,000 only, because 16,000 was paid by the transferor company for dividend. So bank available to be taken over is only 4,000. Okay, bank balance 4,000. Then after bank balance, we have bills receivable. So bills receivable 8,000 as it is. Okay, bills receivable 8,000. Now total agreed value of all the assets taken over will take 1 lakh plus 72,000 plus 35,000 plus 47,500 plus 4,000 plus 8,000. So 2,66,500. From that, we have to subtract agreed value of liabilities taken over. Okay, from that we have to subtract agreed value of liabilities taken over. Now two liabilities are taken over, debentures and creditors. Creditors, we assume they are taken over. Tax was given, tax liability, so we assume it is paid by transferor company itself. So debentures, we will take the agreed value, that is 64,800. Okay, 12% debentures 64,800 agreed value. And creditors, we assume they are taken at book value only. Okay, in absence of any information. So creditors are 37,000. We'll take 37,000 itself. So 64,800 plus 37,000, 1,01,800. So 2,66,500 minus 1,08,000, 1,800. That comes to 1,64,700. That is amount of net assets. Okay, that is the amount of net assets. Now against that, the purchase consideration paid is 2,96,000. Okay, how much more we are paying if you compare with that? 2,96,000 we are paying against 1,64,700. So we are paying 1,31,300 less. So that is the amount of goodwill. Now we can pass the second entry straight away from this. Land and building account debit 1 lakh. Then plant account debit 72,000. Then Stock account debit 35,000. Then debtors account debit 47,500. Then bank account debit 4,000. Then bills receivable account debit 8,000. And what else without fail you must debit? Goodwill. Okay, goodwill account debit. Goodwill account debit with what value? 1,31,300 from working note 4. 1,31,300. Got it, everyone? Sorry, working note 5 here because that one more working was there for dividend. Working note 5. Now two liabilities account. So to 12% debentures account 64,800. And then to creditors account, which we have assumed they are taken over at book value in absence of any information, 37,000. And to business purchase account with the purchase consideration of 2,96,000. Okay, you all can see here this amount 2,96,000 is what we have to reverse and credit. And I told you after second entry always verify debit comes equal to credit or not. So if you do 1 lakh plus 72,000 plus 35,000 plus 47,500 plus 4,000 plus 8,000 plus 1,31,300, that will come to 397,800. And then if you do credit side, 64,800 plus 37,000 plus 2,96,000, you'll find that also comes to 397,800. Okay. Then the narration being assets and liabilities, of B Limited taken over. Then third entry, settlement of purchase consideration. Liquidator is the receiver, debit the receiver. So liquidator of B Limited account debit with 2,96,000. Okay, this account we have to reverse and debit. Liquidator is the receiver, debit the receiver. Liquidator of B Limited account debit 2,96,000. How is this 2,96,000 paid? 24,000 equity shares, but face value of 10 will go to share capital and premium of 1 will go to security premium. So to equity share capital account, to equity share capital account 24,000 into 10, face value 2,40,000. To security premium account, same 24,000 into 1 rupee of premium. At 11 rupees they were issued. So 1 rupee of premium, 24,000 will go to security premium. And then cash is given. So to cash and bank account. Okay, cash goes out, credit what goes out. Cash and bank account 32,000. All of you can see here cash of 32,000 is paid. Okay, being purchase consideration settled. Okay, being purchase consideration settled. Then fourth entry, do we have any issue of shares in the public? No, we don't have. Okay, no shares are issued in the public. Then do we have liquidation expenses? Yes. Fourth adjustment, pay absorption expenses 3000, so that entry will come here. For that, since we have goodwill in entry number 2, we will pass what entry? Goodwill account debit. Okay, for absorption expenses, goodwill account debit to cash and bank account. Goodwill account debit to cash and bank account. And what are the amount of absorption expenses? 3000. So goodwill account debit to cash and bank account 3000. Being absorption expenses paid. Being absorption expenses paid. Then after absorption expenses, do we have any establishment expenses given in the question? No. No establishment expenses are given. So directly after that, the last entry, payment of liabilities, settlement of liabilities. So in that we have debentures. Okay. Now in debentures, very first what we will do is this 12% debenture 64,800 we will reverse and debit. So 12% debentures account debit 64,800. And then new debentures are issued at discount. You all can see here in the first adjustment, 15% debentures are issued at discount, 720 debentures are issued, 10% discount, 10 rupees. So that discount of 720 debentures we will debit. Discount on debentures account debit with what amount? 720 into 10, 7,200. And then to 15% debentures account. Okay, 15% debentures are given to them with the face value. So the 15% debentures account, 720 into 100 rupees face value, 72,000. All the entries are done. Last entry is generally for a statutory reserve, but that we don't have in this question. So total 2,96,000 plus 64,800 plus 37,000 plus 2,96,000 plus again 2,96,000 plus 3,000 plus 72,000. Total comes to 1 crore, no, 10,64,800. Both the sides 10,64,800. Okay. Now at the end, all of you just write down one important note. What note? You all mentioned that it is assumed that creditors, it is assumed that creditors are taken over by A Limited at book value. It is assumed that creditors are taken over by A Limited at book value. Okay. So all the accounting of this part is done. Now next question 14 I have given you in the homework to try on your own. It is a very simple question and is based on, be careful, it is based on amalgamation in the nature of merger and lump sum purchase consideration. It's a very simple question which we had done in the beginning of the chapter. So I assume question 14 you all will be able to do on your own. Okay, that will be all for today's lecture. Bye everyone, take care, see you in the next lecture. Love you all.